Invest in what you know, how an ordinary mindset built extraordinary wealth. Peter Lynch is widely celebrated as one of the greatest investors in history, not because he followed complicated economic theories or spent his time trying to predict macroeconomic turns, but because he embraced a remarkably simple and radically effective philosophy: invest in what you know. During his 13 years managing the Fidelity Magellan Fund, Lynch delivered an astonishing annual average return of around 29%, transforming the fund from $18 million to more than $14 billion. But the true power of his legacy lies not only in the numbers, it lies in how he empowered the everyday investor to believe that their personal experiences and observations could reveal world-class investment opportunities long before Wall Street ever paid attention. According to Lynch, the stock market is not an exclusive arena reserved for financial elites. Instead, it is a giant marketplace filled with businesses we interact with every day, when we shop, eat, commute, or simply observe what people around us are excited about. He firmly believed that regular individuals, teachers, nurses, homemakers, retail workers, often encounter the next big winners before analysts publish a single report. Why? Because everyday life gives us first contact with trends. Lynch argued that if your local mall is buzzing with a new fast food chain, or if your children can't stop obsessing over a new brand of shoes, then you might have stumbled on a company poised for explosive growth. He famously discovered investment ideas while shopping for pantyhose with his wife, noticing the popularity of Hanes products before Wall Street realized how strong the brand was. And he didn't hesitate to invest heavily, eventually profiting immensely when the company succeeded. This approach was grounded in an important psychological truth: people understand their own world far better than the entire financial market. Investors often panic because they invest in companies they don't comprehend. If you don't understand what a business does or how it earns money, fear takes over at the first sign of volatility. Lynch wanted investors to feel the opposite: confident, informed, and calm, because the companies in their portfolios are part of their daily lives. However, Lynch never said you should buy a stock only because you know the product. His philosophy is often misunderstood as simply, buy what you like, but he always emphasized a crucial second step: do the research. Spotting a product in the real world is only the first clue. From there, Lynch would dive deep into fundamentals, growth rates, debt levels, competitive advantages, expansion opportunities, and most importantly, a company's story. To Lynch, every winning stock had a compelling narrative, and he loved narratives that Wall Street ignored. If he found a business that was growing fast, overlooked by analysts, and supported by a strong balance sheet, he believed he had uncovered a potential 10-bagger, a stock capable of increasing 10 times in value. And those 10-baggers became the defining element of his performance. Lynch's career was built not on avoiding failure, but on letting the big winners run. He often joked that you only need a handful of huge successes to make up for all your mistakes. If you have 20 stocks and just 2 become 10-baggers, you can afford several losers and still end up very rich. The key was to recognize explosive potential early, and that required boots-on-the-ground observation. He encouraged investors to be detectives of capitalism. Watch which stores have long lines. Notice what teenagers are buying. Pay attention to restaurants that are always packed. Investors living real life have access to data that financial models cannot measure. That is the power of Lynch's approach: your eyes can outperform the smartest analysts, if you trust what you see and verify the details behind it. But Lynch's philosophy was not only practical, it was deeply optimistic. He believed the world is continuously filled with opportunity. Markets rise over time because businesses innovate, expand, and compete. Short-term downturns are temporary, but great companies keep growing. His belief in everyday insight transformed hundreds of thousands of ordinary Americans into confident investors. He pushed back against fear-driven market behavior, insisting that volatility is normal and research is the antidote to panic. When the market drops, many people sell first and think later. Lynch did the opposite. Downturns excited him, because falling prices offered great companies at discount valuations. He believed that if you understand what you own, falling markets are not threats, they are invitations. Lynch always said, if you can't explain to a 10-year-old why you own a stock, you probably shouldn't own it. He wanted investors to strip away jargon and focus on real-world logic. Does the company solve a problem? Do customers want its products? Is it expanding with consistency? His famous scuttlebutt-style research involved visiting stores, talking to employees, and learning from first-hand experiences. These observations often revealed more truth than balance sheets did. But Lynch also respected numbers. One of his signature tools was the PEG ratio, price/earnings to growth, which helped him determine whether a company's valuation aligned with its growth rate. A PEG below 1 suggested undervaluation, especially powerful when combined with strong visible demand. His system was not built on prediction, but on recognizing what is already happening before the market notices. He encouraged investors not to chase trends after they explode, but to find them at the early adoption stage, the moment you begin to see consistent signs in everyday life. Lynch's genius is that he transformed curiosity into a financial weapon. Every shopping trip, every magazine, every conversation, all became sources of investment intelligence. He took investing out of the abstract and grounded it in human experience. And in doing so, he democratized the stock market. His philosophy became a mission: ordinary people can build extraordinary wealth, not through luck, but through awareness. Invest in what you know is more than a strategy. It is a mindset. A mindset that trains investors to stop fearing the complexity of markets and to start recognizing the simple truths happening right in front of them. And through this down-to-earth approach, Peter Lynch permanently changed the way the world thinks about investing. Finding 10 baggers, the hunt for hidden giants in plain sight. Peter Lynch believed that the greatest investment opportunities were rarely loud. They didn't arrive with headlines, analyst hype, or dramatic TV interviews. They often whispered quietly in local neighborhoods, hidden behind everyday consumer habits, waiting for someone curious, someone like you, to notice. Lynch was a master at turning these whispers into life-changing investments. He called them 10 baggers, stocks capable of growing tenfold. To him, these weren't miracles, they were the natural outcome of spotting exceptional companies early and holding on long enough to experience their full potential. But how did he find them? And more importantly, how can anyone else follow the same playbook? Lynch's starting point was always awareness. Unlike investors who begin with crunching numbers, Lynch started with observation. He paid attention to trends forming organically in society: a product sold out everywhere, a restaurant chain opening new locations at lightning speed, a service everyone suddenly started talking about. This real-world pulse check gave him a front-row seat to emerging consumer behavior, long before Wall Street's radar detected anything unusual. But Lynch didn't merely chase popularity. He wanted to understand why customers loved the product. Was it cheaper? Faster? Better quality? More convenient? More fun? Lynch believed that behind every 10-bagger lies a simple, powerful reason that connects deeply with consumers. And that connection turns into accelerating revenue, expanding footprints, and ultimately explosive stock returns. However, even when Lynch found something with potential, he didn't buy instantly. He investigated passionately, reading annual reports late into the night, visiting company headquarters, interviewing employees, suppliers, and even competitors. He wanted to understand a company like a detective trying to solve a mystery. His goal: uncover a narrative that explained future growth. Lynch famously said, "Stocks are not lottery tickets. There's a company behind every share." And with this mindset, he categorized companies into 6 types, a system that helped him manage expectations about growth and risk. Keycap 1: slow growers, mature companies with modest growth, not usually 10-baggers. Keycap 2: stalwart, strong household names, reliable performance. Keycap 3: fast growers, his favorite category, small aggressive businesses scaling rapidly. Keycap 4: cyclicals, companies that rise and fall with the economy. Keycap 5: turnaround, struggling companies with potential for dramatic recovery. Keycap 6 asset plays hidden value companies overlooked by most investors. The fast growers were where Lynch hunted his legendary winners. These companies weren't enormous giants yet, they were still climbing. And because they were small, their runway was long. A company growing earnings at 25 to 30% annually, if valued reasonably, had enormous potential to multiply capital over time. But Lynch also warned that fast growth brings volatility. A great company doesn't grow in a straight line. There are setbacks, economic slowdowns, unexpected challenges, and temporary panic in the stock market. That is why understanding the business was essential, because only conviction prevents investors from selling early and missing the real prize. Lynch once said, "The real key to making money in stocks is not to get scared out of them. Panic is the enemy of compounding." Many investors lose their future 10-baggers because they sell at the first sign of a dip. Lynch learned to embrace the dips as opportunities. If a company's fundamentals remained strong, a falling share price meant a chance to buy more at a bargain. This is what differentiated him from emotional traders. He trusted research more than he feared volatility. Another cornerstone of Lynch's method was finding growth that Wall Street ignored. He loved companies in boring industries. Funeral homes, waste management, niche manufacturers, the types of companies analysts yawn at. Lynch argued that boring businesses are often gold mines because competition is weaker and investors overlook them. As he said, if you invest in a company everyone loves, you'll pay a premium price. But invest in something dull, the profits are waiting quietly. One of his favorite examples was Dunkin' Donuts. It wasn't a glamorous business. It wasn't disrupting anything. It simply sold coffee and donuts, and did it better and more efficiently than anyone else. That simplicity turned into massive growth. Lynch's philosophy reminds us that we often overcomplicate success. We search for sophistication, when sometimes the winning path lies in observing the ordinary. But beneath his practicality, Lynch also embraced optimism. He believed in the resilience of capitalism, that entrepreneurs continuously build better solutions, that new creativity constantly reshapes the world, and that investors who participate patiently can share in that progress. He famously challenged economic pessimists. When recessions hit, many investors assumed the world was collapsing for good. Lynch saw history differently. He studied over a century of market data and found a timeless pattern: companies innovate, economies recover, and markets eventually reach new highs. Temporary fear creates permanent opportunities. Another crucial part of Lynch's philosophy is that geometry beats emotions. A 10% decline feels terrifying, but a 10x return feels almost unimaginable. Lynch taught investors to stop focusing on small movements and instead imagine the full growth arc a company could travel. A company you understand and believe in is worth the patience. And patience is what multiplies wealth. Yet Lynch never claimed perfection. Even he picked losers, many of them. But he didn't care. Because the winners overshadowed the failures by such a staggering margin that mistakes became irrelevant in the final outcome. That is perhaps his most reassuring lesson: you don't have to be right all the time, you only need to be right big. And the way to find those big wins is to look around you with curiosity. What product changed your daily life? What brand did your children introduce you to? What service are people recommending everywhere you go? Lynch's genius lay not in elite education or complex modeling, but in having the courage to believe that everyday life reveals the future. His philosophy invites every investor to join the hunt, not from a skyscraper boardroom, but from the real world we all share. When you start looking, you'll realize something incredible: the next 10-bagger might be in your shopping cart right now. Peter Lynch believed that the true power in the stock market did not lie on Wall Street, but in the hands of ordinary people who lived, observed, and interacted with the real economy every single day. His philosophy suggested that being a consumer, an employee, or even a casual observer could make someone a better investor than many professionals. Because while analysts sit behind screens and overthink every macro headline, everyday people see trends unfold right in front of them: new restaurants filling up, products selling out, technologies becoming necessities. Lynch argued that these observations were clues, early signals of growth before the market recognized them. But noticing something promising was only the beginning. Lynch stressed that investors must understand what they own and why they own it. Buying a stock simply because a store is crowded is reckless. You must research the business behind the product, evaluate its financial strength, growth potential, and competitive advantage. Lynch's belief was simple: if you cannot explain how a company makes money in a few clear sentences, you have no business investing in it. When you truly understand a company, fear loses its power over you. Market drops and media panic no longer control your decisions because you are anchored to the company's story, not its short-term price movements. This is why Lynch focused on what he called the company story. A strong story includes smart leadership, growing demand, expanding markets, healthy balance sheets, and a clear future. If those elements remain intact, the stock price eventually reflects them. If the story breaks, if growth slows, if management fails, if customers leave, then it is time to sell. That principle formed the backbone of his method for both buying and selling. One of Lynch's well-known tools was the PEG ratio, which compares a company's valuation to its growth rate. Instead of blindly chasing low PE stocks, Lynch looked for growth at a reasonable price. But numbers alone were never the final answer. They were merely a flashlight, useful for illuminating the path but never driving the direction. Lynch was guided by judgment, experience, and the constant discipline of asking, is this business improving, or is it fading? Lynch's most iconic idea, the 10-bagger, captured the excitement of long-term investing. A 10-bagger becomes a life-changing investment only when held long enough. Many investors ruin their own success by selling winners too soon. A 30% profit feels good, but Lynch warned that selling early kills extraordinary outcomes. If the company is still growing, still surprising the market, still executing its strategy, the correct move is patience. Selling should never be an emotional reaction to short-term gains but a rational decision based on fundamental deterioration. That balance, holding with confidence but selling with clarity, is the most difficult part of investing. And to achieve it, Lynch encouraged investors to ignore predictions. Nobody, not economists, not experts, not famous fund managers, can consistently forecast recessions or market direction. Trying to time the market leads to anxiety, lost opportunities, and bad decisions. Lynch famously said more money is lost preparing for market crashes than during the crashes themselves. His message: do not live in fear of the downturns. They are temporary moments in a permanent upward journey of human progress. The world evolves, businesses innovate, and the market eventually recovers. In fact, downturns become opportunities to buy great companies at bargain prices. But none of this works without self-awareness. Lynch understood that every investor is different. Some enjoy analyzing numbers, while others prefer simple business stories. Some can withstand volatility without stress, others panic at the first price drop. He insisted that your strategy should match your temperament, not someone else's. That is what keeps investing enjoyable rather than stressful. And yes, Lynch believed investing should be enjoyable. Discovering strong companies early should feel exciting, like participating in the future before it arrives. When you invest in what you know and believe in, the journey becomes personal. You cheer for the business not merely because you want profits, but because you truly admire what it creates. Lynch democratized investing. He removed the illusion that only experts can succeed. His success at the Magellan Fund proved that a thoughtful individual can outperform the smartest institutions. His teachings empower people to see their environment as a map of investment ideas, the stores where they shop, the brands they trust, the technologies that improve their lives. If you stay curious, pay attention, and remain patient, you can discover the next major success story before the financial world catches on. Lynch's philosophy encourages courage in conviction. The stock market will always test your resolve, headlines will scare you, price swings will tempt you, opinions will challenge you. But if you rely on understanding rather than emotion, time becomes your advantage. Compounding requires time, and time rewards those who remain invested in growing businesses. The essence of Peter Lynch's message is simple: the market is full of undiscovered opportunity. Extraordinary companies are quietly building the future while most investors are distracted by short-term noise. Anyone can find these companies if they observe life closely, question what works and why, and invest patiently in businesses they truly understand. Wealth does not require genius. It requires awareness, curiosity, discipline, and belief. The next great investment could be right in your neighborhood, in your pocket, or on your screen at this very moment. Peter Lynch showed the world that the true advantage in investing lies not in Wall Street sophistication but in ordinary insight. He proved that successful investing is not about timing the market, it is about spending time invested in companies worth owning. The opportunities are all around us. We just have to notice them. Thank you for joining us on this deep dive into the investing wisdom of Peter Lynch, a legend who proved that ordinary people can become extraordinary investors by simply paying attention to the world around them. If you found value in this story and if Lynch's philosophy sparked new ideas for your own investing journey, then you're already one step ahead of the market majority. On this channel, we continue exploring the minds of the greatest investors in history and uncover timeless lessons that help you make smarter financial decisions. So don't leave just yet. Hit that subscribe button and turn on notifications so you never miss an opportunity to level up your investing knowledge. And if you enjoyed the video, give it a like and share it with someone who dreams of building wealth the smart way. Your support helps us keep creating high-quality, educational content. Thanks for watching, stay curious, stay disciplined, and as always, invest in what you know. See you in the next video.